You might have heard of more and more people putting their money into the Singapore savings bonds. These bonds have been oversubscribed in recent months, given how their returns are looking fairly attractive in an environment of rising inflation. To put it simply, these are a type of bond issued and fully backed by the Singapore government. It was first launched in 2015 as a safe and flexible investment option for individual investors like you and me. New tranches of the bond are open for application at the start of each month with fixed interest rates that step up each year, meaning the longer you hold on to the bond, the more interest you get per annum. Each savings bond has a term of 10 years. The investment amount starts from $500 and can be paid via cash or funds in your supplementary retirement scheme. If you apply for the bond, you will know the results by the end of the month. And once the bond is issued, interest will be paid out every 6 months. The interest rate for each Singapore savings bond is linked to the average yields of the Singapore government securities in the previous month. Now, these yields have been on an uptrend as global central banks tighten monetary policy to fight inflation. And with that, the 10-year average return for Singapore savings bonds issued this year have been rising, up from 1.78% in January to a record high of 3% in August. For the latest September issue, this has dropped slightly to 2.8%. Experts say the interest rates for future Singapore savings bonds will depend on the outlook for inflation and whether global central banks continue to tighten monetary policy. First, it is a fairly accessible option for most people given how investors can put in as little as $500. Second, experts say it is almost risk-free given how it is fully backed by the Singapore government, and unlike most investment options, the returns are fixed and are not affected by fluctuating interest rates. Third, it offers flexibility. While it is labeled as a bond with a 10-year maturity, investors are free to withdraw or redeem the savings bond anytime. There are no penalties involved, and accrued interest will not be forfeited. However, there are also downsides to be considered. For one, withdrawals are not immediate and can take up to 30 days. Also, with the strong demand recently, applicants might not be able to get the full amount that they applied for. For example, in August, successful applicants were allotted $9,000, down from $18,000 in July. This means that several attempts may be required before an investor gets to accumulate a desired amount in the Singapore savings bonds. Overall, experts say that you should be thinking of bonds and lower-risk investment products as stabilizers in your investment portfolio, especially at a time of heightened market volatility. Given the step-up in interest rates over a period of 10 years, Singapore savings bonds can be an attractive option to build up long-term savings, especially for retirees or people with lower-risk appetite. For younger investors, the bonds can also be a place to park extra cash that you need in the short term, say over the next 1 year or 5 years for your wedding or down payment for a BTO flat, given how the average returns are still higher than a bank's savings account, and it also offers you flexibility compared to, say, fixed deposits. But ultimately, experts say that individual investors should avoid putting all of their eggs into one basket. Also, returns from lower-risk investment products such as the Singapore savings bonds are unlikely to keep pace with inflation over the longer term. So, depending on your life goal, investment horizon and risk appetite, you should still be aiming for a well-diversified portfolio that is made up of different asset classes in the long term.